Hello, everyone. This is Calvin Russell, CEO and founder of 850 Club Credit Consultation. Hope everyone's doing well today. Today, we're going to talk about what happens exactly when you or someone that you have given access to checks your credit score. All right, let's go ahead and go into it. So, number one, when someone checks your credit score, your credit report, your credit in general, right? It just really depends on who the person is. So, for example, if it's a financial institution, usually if it's anyone that you've given your social security number to, in most cases, they probably won't charge you. Some mortgage companies do charge you a credit application fee of $95 or less or more. If you go to the dealership, obviously they usually won't charge you for that. But anytime you give your social to financial institutions, you're looking to get an idea of what your credit is going to end up being, unless they specifically say that doing this will not harm your credit score. Like if you go online, it'll say pre-qualified, things of that sort. If they don't say that, then expect it to affect your credit score. That's just the name of the game. The reason behind that is because in most cases, people don't necessarily apply for credit unless they want to just see what they qualify for. They want to try to get something or whatever the case may be. But then you really have the people that damage a lot of things and they're in dire need of a credit card. They're in dire need of getting a personal loan, and those increases start to slowly add up, unfortunately. Now, that's if you're looking mainly for anything that's outside of getting a car or getting a mortgage. Now, thanks to mortgages, you can have your credit ran a certain amount of time, well, unlimited amount of times within a 30-day period. Now, that's the only limit time frame that there is. Now, FICO will still show who ran your credit, but it won't affect your score unless it is after that 30-day time frame. Okay. Now, some people may say 90 days or 60 days, whatever the case may be, but I know for a fact that it's within 30 days for sure. You start messing around 60 days, 90 days, eventually you're going to see that those increases are there. But what you really have to change your approach to it. For example, in order for someone to give you an accurate interest rate, they must see not just your credit, but what's on the report. They must see what your entire financial picture is altogether. But what a lot of people do, they just fill out the application, they ask questions later. I don't really recommend that. I recommend getting your credit ran one time and then using that information that they can see and then sharing that with other, lenders, brokers, things of that sort. It's only so far you really can get by doing that, but you can at least get your questions answered. Let's be honest. We want to know what the interest rates are. Very seldomly is your interest rate going to be substantially different than someone else's. Okay. For example, you may have, an interest rate quote of, let's say, 15%. Chances are you're probably going to be close to 15%, if not higher, at other places. Okay. And typically, people with good credit, and I will say good credit, yeah, usually anything above 680, usually people that have good credit scores over 680 and above, they already know the drill. So they know what questions to ask. They say, hey, my FICO auto score, whatever, my mortgage score, FICO, my FICO mortgage score, whatever. And with whoever they're talking to, that could be the whatever. All right. And they'll say, hey, this is my score. What rates do you have for this score bracket? And those are the type of questions that you want to have instead of just essentially, pre-committing to everyone by giving your social like it's your phone number. Okay. So it's okay to ask questions before you fill out these applications. Okay. That's when you are giving someone your information to find out what you can qualify for. Now, again, there's a lot of soft pull platforms out there, and they won't even ask for your full social. That's another thing. Most soft pull platforms, those are essentially places that you can see what you qualify for without getting the hard inquiry, like you would, with the earlier situation I explained a few moments ago. When you're doing a pre-qualification or a soft pull, anything like that, they normally don't even ask for your full social anyway. Okay, so just keep that in mind. Usually, when you're going to get a hard pull, a hard inquiry, they want the full social. Okay, usually when they don't want the full social, chances are that you're probably not going to get the hard pull, but you can always ask, double check, things of that sort. If it's a human person, trust me, anytime you're giving your social to a human person, most of the time it's going to be a hard pull. That's just what that is. Again, that's your full social. Now, you can also just get myfico.com yourself, right? And then once you do that, you can easily just show them what the reports are, and they can get an idea. Now, when you're talking about getting a mortgage or a car, things of that sort, in order for them to give you an accurate number, they're going to have to run it so the system can put the calculation in there, okay? So I know it's not many ways around this, but that just is what it is. Now, what happens when you check your credit score, your credit report, right? There's a soft pull, it's a soft increase. You still can see soft increase on your credit report, but there's a special section for that. You actually got to get credit monitoring to even see that. But most basic credit reports are going to always show the hard increase. They rarely ever show the soft increase, because people, they think they see it, they immediately think that it started to that it's affecting their score, when soft increase, soft pulls do not affect your score in any way, shape, or form. So anytime you check your own credit score, whether it's for free or whether you pay for it, it does not affect your credit score. And the only time it does is when you are giving it to someone else, like a financial institution. You're trying to get lending, financing, things of that sort, and they're giving you loan options, okay? And again, it never hurts to ask questions prior to giving anyone anything, just so you can confirm, all right? So hopefully that was helpful, because we've been getting this question a lot, and I did a video on something similar years ago, but of course, as times change, there's been a lot more soft pull opportunities for people, which is honestly amazing. But again, and don't lie on the application, guys. Anytime you're looking for financing or whatever the case may be, it's best not to necessarily lie on the application, because they're gonna, a lot of times that that rate is tied to income. A lot of times that rate is added to time on your job. And when they see those check stubs, they do a verification of employment, usually with mortgages. Sometimes that could change, that interest rate. So just kind of keep that in mind. It's best to tell the person first before you lie on the application. Be upfront with everyone, because there are lenders that are there. Like, for example, if you're looking for a car but you don't have your license, there's auto loan lenders that will give you an auto loan that don't look for licenses. If you're looking for a mortgage but you're in a bankruptcy, there are lenders who will give you that mortgage at a regular rate. So again, tell people what the situation is first, and then let them craft that together. And if they don't know what the hell they're doing, it's okay. Just switch people up, okay? You're never stuck. You always have options. Remember, you are the economy, not the economy. Without you, there's no economy, okay? So just keep that in mind. If you like this video, like it, you want to share it. And as always, be sure to subscribe, as we have nothing but great content on the way. Thank you all so much. Have a great day.